All right, welcome everyone. Welcome to the trade findings and adjustments for Tuesday, the 21st of 2020. I am going to give you a disclaimer today. And my disclaimer is that tonight, this way, tonight I am, how would I say this? I'm definitely not dancing in the rain. So my disclaimer is tonight I am brutally honest, no bullshit, frustrated with a family member, and excuses, how do I say that? Excuses never work for me. And that's because an excuse is like a butthole. Everyone has one. Not interested in hearing it, seeing it, or smelling it. So there we go. So we're on one tonight. Plain and simple. If I was going to do a trade for this week, it is a protective put on FCX. And I am going to hit some things on the back end here, but plain and simple, if I was going to do a trade, I would go to FCX, Freeport McMoran. The main reason why I really like these guys and I like them today is that their price is right around, especially extended hours at 1352, right around a strike price. But more importantly, if you pull these guys out, let's go 5 years. If you go 5 years, you have a $20 strike price in 2018. If we go to 2014, 5 or 6 years, we've got a $39.32 strike price. And if we go back just a smidget more, we can go back to 8 years ago, a $48.96. Kind of irrelevant though. More relevant is going to come back down to the $20.25 in January of 2018. So we're going back about 2.5 years. That is what I'm looking at. That is my upside potential. That if I was going to say, hey, I'm all over it, that is what excites me about this stock. That is the upside potential that we now have in Freeport McMoran. So if you were going to go ahead and get into something like this, you're probably looking at your 100 shares. Again, I would at least do 300 shares. I would add an option and I would choose to use the August monthlies. I would make it a put, not a call. I would definitely want to get in at that 1445 level. And this would be the trade. It's simple. It has a lot of upside opportunity. It's relatively cheap for a trade. And really, when you do your snapshot analysis, huge upside opportunity, great downside protection, and you're off to the races. It's simple, it's easy, it's one that I love the risk to reward. So if I was to stick some of these in here, I'm going to stick them all in here, right? Kevin, you can't do just some, do them all. Huge long-term upside opportunity. It's a simple trade. It's easy, and infinite maximum profit is my key. In all honesty, I'm thinking at $20 you could get out with a good 40% return. It's also a cop-out trade. What do I mean by that? So the protective put is a cop-out trade because you can be wrong, and the downside is 10 bucks or roughly 30% more shares of stock. Upside is to $20 or $6.65, roughly 42% return on investment. If stagnant at a short put below or above the long put strike of 1350. It's simple, it's easy, it helps in an uncertain time. So let's get on to other positions that we could be in, and I'm going to kind of point something out, and that's going to be some of my frustration tonight. Welcome to the tell it how it is kind of individual. Some of you that might have some of the Apple leaps are doing ridiculously well. I believe we had the 300 that $46 are worth 112. There's some of you that have the where's the big one? I thought it was 350. Why is this? Oh, this is my non-student group. Let me go to another, well, I'll use it. The non-student group, we probably have 35, 350s. All of your Apple leaps, you can close for a profit at any time. Boeing, for those of you that joined us in our Boeing leaps, we're down to 41 in these accounts. It says a cost basis of 128, we're 315. The real cost basis is closer to $7.13. But we have taken 2 off for a profit of roughly $2. So the leaps are waiting on January 350s. We're waiting on Boeing to come back. 29th, I believe, is their earnings. It will be interesting to see what we get from there. Some of you may have joined in at our 330 or 350 January 22s. That was taking the profits from 2 strike prices here and moving it out in time. Bank of America, we do. I should just go to you guys. I should go to you guys. No, Parker. We do have some leaps on Bank of America. Some are profitable there, some are not. Active puts, where are leaps at? We've got some that are the January 22 $30 calls for $2.36 that are worth $192 right now. We also have another big group of January 7, January 22, 30 calls that are that same group. They're just separated differently. No worry, no concern. We took some leaps off here recently to get into those for a nice profit. Baidu, we've got a bunch of 135s, could be 120s, 150s in January 22. Plenty of time. They had great earnings. They got as high as 135. Patience, 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 patience. Moving on along. Disney, we do have some Disney. Where's the big ones? The 150 leaps, $6.07 worth $4.55. It'll be very interesting to see if this is one that gets forgiveness. But again, we still have plenty of time there that we can hold and be patient on. Hopefully, movies will come up. If not, we will have to be buying more time for Disney. Boy, I hope they have a great earnings. Those that might have been an FCX in the past, you should have a cost basis around $8. Some of these are coming over from a different account with a cost basis of $42, lowered down to $18.28. But those that joined us at the $8.50 level that have a cost basis somewhere between $9.30 and $9.55, you are nicely profitable. You can exit those for over a 35% profit, if not more, a 50% profit, right? $4.20 on, yeah, about 45-ish maybe. A good place to be out and to be profitable there. We have some Under Armour way out in time. Leap calls. This is one that it might be good because it's in half to double up on those, but you have all the way till January 22. So now would be a good time to maybe lower your cost basis and double up on those and cut your cost in half. We do have some Visa Leap calls that are out there. We took some profits on them, but where's the group? June 22, 200s at $25 worth 30. There's a 20% return if you chose to take your profits on those. January 22, 200s are profitable, 215s are profitable, 220s are profitable. So all the leaps are profitable on Visa if you wanted to get out before their earnings that are coming up. I'm going to make a quick comment. And here's the short answer. If it sounds too good to be true, then damn it, it is too good to be true. And I'm going to put this in plain, simple English. Not a problem. I appreciate it when you guys come to me. When even if I am in a bad mood, you'll say, hey, Kevin, deal with it. I received 3 high yield. These are great investments. It actually, I think, came to me from 2 people. But one said, you know what, Kevin, this is more what I'm looking for. And my answer was, you've got to be something kidding me. It starts with an F and ends with an ING. And he said, but you don't get it. And I said, really? You're going to talk about a blend of 3 ETFs. He said, compare the statistics. And I said, okay, let's compare the statistics. Help me understand what you see here. And it's shocking because two of you brought this to me, which I'm not sure where that comes from, right? But I said, let's just call it what it is. S&P annualized return is 10.38, and this blend is half of the benchmark. So I don't understand. Well, Kevin, the Sharps ratio isn't bad because it has such a low standard deviation. Well, the Sharps ratio is your risk ratio. And damn it all to hell, it's 50% worse than the S&P 500. I don't understand. Well, it won't go down as much, but it won't make you as much. I mean, it makes you a quarter of the highest return. The worst part about this, superior risk-adjusted results, right? And I'll be honest, it looks pretty. So let me tell you one more thing. When it looks pretty, you need to run the hell away from it. Because when it misses 28% returns for 10 or weird drops, I just don't get it. All performance is net management fees. Management fees have been taken out. Oh, but then you go to the disclosure, right? Where this is what they're really held on to. This is what, hey, this is the small print. With all due respect, this bullshit is the big print. And for crying out loud, what the hell does that say? It is a simulated performance. It is not a real performance. It is back testing with already knowing what the hell these stocks are doing. So when they're put in here, you know, oh, these are going to look better than they should. As you go through some of this, it just pisses me off. It's an attempt to synthetically reproduce such trades. It's Bet's effort to replicate the performance in trades. It's in an identical manner for the investor. It's bullshit. It's not real. They are unable to compensate for the model risk and returns depicted in their model. No representation is being made that any investor will or is likely to achieve these profits and losses that are shown. It goes even farther to say, even though they said it was net of fees, bullshit. It does not reflect the deduction for any performance fees, ticket charges, commissions, trading fees, due to variable unpredictable nature of fees. Account may be lower when you take out the real fees and expenses. because they cannot be predicted for this presentation. So why the hell do you have all of this? Oh, because it's not real. Oh, don't forget, there's a rider that you have to purchase to maybe get some of this. Oh, don't forget, there's another disclaimer. From third-party sources we believe to be reliable to get these returns. There's no representation or warranties of the accuracy of such information. I just am shocked to hell that this would be presented out there. Here's another one, a bond index. Oh, it's now double the S&P during this time frame. How the hell a bond index is 150% more risk than the S&P 500? Thank you, Abraham. It's a bond index that has 150% more risk than the S&P 500. I don't get it. Historical charts, year to date, oh, 30, 20s. If I'd see this, I'd be, oh my gosh, this is unbelievable. Even though it has no correlation, no alpha, no beta, great return. I knew this was bullshit. All performance is net. Oh my gosh, it's another simulated performance in big print. And as you read through all of these disclaimers, oh my gosh. It basically says that this reflects no actual trading history. It is not based on any representable calculations. We are 100% bullshit here, period. But it looks pretty. How a bond can have 150% more risk than the S&P, there's your first red flag that you run. Last one, kind of an amazing one, right? Top 5 sector ETFs and the Treasury Index. Again, twice the return of the S&P basically. Less risk, sharp ratio, standard deviation, less standard deviation, but somehow it has less risk. Well, not really. It has twice the amount of risk if the sharp ratio is there. Sorrentino ratio, almost 2.5 times. I don't get it. Average return, I don't get it. Lowest returns, highest returns, I don't understand it. It looks pretty. This is even prettier than the other one. Oh, it's simulated. As I went through this one on ETFs, not only can they not name the ETFs, but it's simulated ETFs with no sector to follow, no sponsor investment or managerial numbers to justify in here, no idea what the fees are, commissions, charges. This is completely made up. Yet, this was sent out by SmartX as things you guys could invest your money in. If it looks too good to be true, It is. If they don't open up portfolios and show real trades, it is. If it's some history that doesn't show live anything, it's doctored, it's fake, it's garbage. This is what you guys are up against. The game is to collect people's funds. And the problem is what's presented is BS. Guys, I'm frustrated because a family member isn't making the best choices right now. And he's going to learn the hard way, and he doesn't have to. For you guys, you also don't have to learn the hard way. Take what you're seeing, take it to someone reputable, have your stuff looked at. But right now, the game in the stock market is it's not what kind of return I give you, it's how quickly can I collect your funds. And oh, by the way, it's always the stock market's fault when things go down, not my own. You have to do some more research on what's sent to you. You have to take a look and read the small print. You have to take the extra mile and bring this bullshit that's out there to someone reputable to show you all the holes that are in what Dodd-Frank was supposed to prevent for you, what was supposed to now not happen and be easier. You have to take these extra steps, because as bad as I've ever seen it, going back to the 2000 .com bubble, the 2008 financial bubble, the 2096, what was that one? That one was the retail. I want to say 87 was oil or mortgage rates. It's all bullshit. Everything is. Look at it, read it, understand it, and understand it's not something you ever want to be in. This is going to be a fun one to review. This will be a fun one because I'm a little frustrated right now. This is one that you have to look and re-listen to again to enjoy. If you're looking for a new, cheaper trade, FCX with a protective put, a lot of upside, no downside. I normally would do questions, but I'm not going to be in a great mood to answer questions today. So please go ahead and hold those questions and send them to me via email, or we'll talk about them again on Thursday morning. But guys, have a good evening. FCX, a protective put. I will get this one posted. And if you're ever in a bad mood, go back and listen to this so you can laugh at me. Guys, have a great evening. I appreciate you being here tonight. Take care, and I look forward to seeing you Thursday morning. Bye-bye.